in block grants and down payment assistance programs to cities and counties for first-time home buyers. And speaking of first-time buyer financing, the Mortgage Assistance Program is probably the leading program that FHA is offering right now. Here are some of the details. Here are some of the eligible areas in Orange County. These are the property types that are eligible for financing. These are some of the underwriting criteria. Here are the upcoming seminars that your borrower will have to attend in order to qualify for the loan. Here are the income limits for this program. Now notice a household size of 2 is basically $60,000. Multiply that by 3.5, you get roughly $210,000. You're not going to buy a whole lot in Orange County for $210,000. However, there is a solution to this issue. Unlike the traditional FHA financing, which do allow non-occupying co-borrowers, this loan, the Mortgage Assistance Program, allows for a non-occupying co-signer. The main advantage of this is their income will be used to qualify, but will not be used in the determination of the maximum household income. In other words, it will not be counted against the income ceiling. As of September 08, the California Housing Finance Agency, known as CHFA, ran out of money. And as this seminar is being recorded in January of 09, it is still out of money. And given the future budget problems of California, I wouldn't expect this loan program to get funded anytime soon. My tax license has long since expired, but when you read the fine print of this tax credit, you'll find it's really not a complete tax credit. It's more like a tax credit that has to be repaid, almost in the form of a loan. That may change with the next administration, as of they are trying to jumpstart the housing market. For more information on affordable housing programs, here's the website. Now let's refocus on the benefits of standard FHA financing. Here are the high points. Which brings us to our next frame. Daddy, will you buy me a home for Christmas? You already bought me a pony and a Porsche, and after all, I'm a princess, and now I want a house. So any family member can give 100% of the down payment in the form of a gift. Family member is subjective. It can be a long-term family friend, a member of a congregation. You get the picture. Also, the total income of all borrowers is used, and the occupant does not need income to qualify. In the case of parents buying a home for their children who are in college would be a perfect example of this. No conventional lender allows non-occupying co-borrowers. In general, FHA does limit the number of loans that a borrower or co-borrower can have with FHA at any one time. However, these are the exceptions. Here are the property types that FHA will lend on and the restrictions for those property types. Here are some additional restrictions on the property types. One thing to note, you can probably win a beer in a barroom bet, is that FHA does do units, as long as one of the units is owner-occupied. FHA uses the same standard formula that conventional loans use to qualify borrowers, and the documentation is virtually the same. However, there are certain exceptions that are important, such as higher debt ratios are allowed with compensating factors. Here's a list of compensating factors that are recognized by underwriters while underwriting an FHA loan. Here's an affordability index that shows the higher purchasing power FHA loans offer when compared to a conventional loan. Here's another example that I used previously of a loan that has been completely underwritten and it's just simply waiting for the borrower to choose a property. In addition to higher debt ratios, FHA also has relaxed credit guidelines. Let's cover each one individually. For bankruptcy, it's the 1-2-3 rule. 1 year out of a Chapter 13, 2 years out of a Chapter 7, provided they didn't have a foreclosure. However, if you did have a short sale, you must simply only wait 2 years before you can get a new FHA loan. No foreclosures again in the past 3 years. Judgments must be paid off because they affect title. However, collections may remain open. Mostly, this is done by a case-by-case basis, and often, if a collection account remains open due to a medical procedure, that will often be ignored. Also, phantom debt and identity confusion. result when a borrower has to pay off a debt that they never incurred. Often, this is a result of identity confusion, usually a common surname. Also, FHA underwriters may not require your borrowers to pay off debt that is more than 4 years old in the state of California. It's called uncollectible debt, and it is beyond the statute of limitations. Let me show you how you can use FHA financing to increase your commissions. First, let's log on to HUD.gov to check for any down payment assistance programs that are available in our areas. If none are available, we'll simply structure all purchase contracts to include up to 6% in closing costs for both reoccurring and non-reoccurring costs. These monies can be used to pay a borrower's impounds, insurance premiums, first month's house payment, points, taxes, fees, etc. Let's use an example a $400,000 purchase price. First of all, we're in a buyer's market and homes are selling under the appraised value. What we want to do is convince the distressed seller, the bank, the lender, etc., to agree to the lowest possible net price. In this case, for example, $376,000. Since the appraisal will support a $400,000 purchase price, that will give us $24,000 in closing costs, otherwise 6%, and can be factored into the offer to include carpet, paint, renovation, and etc. The borrower may also choose a 0-point loan and use any additional monies for other costs, or simply pocket them. FHA is currently offering two types of other loans that are quite popular with home buyers. Here are the highlights for the 203K Streamline loan. Your borrower can receive up to $35,000 for improvements included into the loan. The improvements include kitchen, baths, appliances, carpet, paint, etc. It is paid in two draws, 50% at the close of escrow and 50% upon completion. The increased loan amount is based on the purchase price plus the increased value resulting from the repairs. Monies can't be used, though, for structural improvement, swimming pools, credit card consolidation, or oil drilling, although that might be more profitable. Here's how the home's final value will be determined. For the more sophisticated investor, there is a standard 203 rehabilitation loan. Here are the details. Should you need more information, you can always log on to HUD.gov. In closing, I'd like to thank you for the time we spent together today. If you would like to know more about employment opportunities at HighTechLending or being on my mailing list, please give me a call or email. I'd like to know any thoughts you have on the webinar or any suggestions on how to make it better for the future. I know your time is valuable. This market is driving us all crazy, and we all have to work harder and smarter if we're to survive. I hope the time we've spent together has been worthwhile. I want to thank you and wish you good luck.